Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Rick Kalvoda. Rick is the president of the analytics branch for the Americas of Altus Group, the $2 billion intelligence as a service provider to the global commercial real estate industry. Rick, let me start out. I'm fumbling. That's silly. I don't need to do that. I just want to make sure it's worded in a way I keep stumbling on it. So the Americas of Altus Group, the $2 billion intelligence as a service provider to the global commercial real estate industry. So the $2 billion intelligence as the $2 billion, that's the $2 billion
that's the market cap. So
market value. Okay. I'm going to just put that in. So
it's that you probably don't even need to mention that part, but it's provider of intelligence as a service to the global.
I think if it's okay with you, I'm going to back that because it just reads funny.
Yeah.
And I'm like, I don't understand why it's reading funny. So, okay. So, for the Americas of the Altus Group, the intelligence as a service provider group, or the intelligence as a service provider branch for the Americas of Altus Group, the intelligence as a service provider to the if I say the intelligence as a service providing,
so you can call. Let's see. So I'm president of Altus Analytics,
right?
For
branch.
The Altus Group,
right? Branch of the Alt. Okay.
Yeah.
Which is
a
the
global
intelligence
provider of intelligence as a service.
There we go.
Probably the best way. Yeah.
Which is the intelligence as a service provider,
or is the provider of intelligence as a service across the globe.
Okay, is the provide. There we go. Because I'm looking at it, it's just not reading. Provider of intelligence.
Yeah. No, I did. I don't know if our marketing wrote that or if someone on your side wrote that, but it can get a little confusing or garbled. Did they mention I do have I can probably go a little bit longer than half an hour, but
let's get it cooking here. Yeah, okay. We'll make this happen here.
Okay.
Still got the recording on. Okay, that's good. So let's go back to here. Okay, here we go. Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Rick Kalvoda. Rick is the president of the analytics branch for the Americas of Altus Group, which is a service provider of intelligence to the global commercial real estate industry. Rick has over 30 years of experience in commercial real estate consulting with a focus on valuation management. And in just a minute, we're going to speak with Rick about data insights into the quickly changing state of the commercial real estate market. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Rick Kalvoda. Welcome to CRE PN Radio.
Thanks, Darren. Good to be here.
Rick, I'm looking forward to our conversation. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. As you mentioned, a little over 30 years in the commercial real estate business. Started out on the valuation side, doing valuations, and we probably about 10 years into my career, we were acquired by PricewaterhouseCoopers. So that's where I started more the advisory side of the valuation advisory side of the business. And for the past 13 years, I've been with Altus Group, as you said, leading global provider of not only advisory services, but then also data and software as well in the commercial real estate industry. So that's been my 32-year career business.
Got it. So as an asset valuation specialist, are you agnostic to the class of asset, or do you have a focus?
Primarily whatever our investors, and so we work with some of the largest institutional investors across the globe, and so they will historically have primarily focused on the four major food groups. So think office, industrial, multifamily, and retail. That has changed quite a bit over the past, let's call it 10, 15 years, where there's been other alternative asset classes that have come into or sectors that they've invested into. So think student housing and single family rentals and self-storage, medical office, et cetera. So we pretty much work with any of those real estate sectors within the industry.
Got it. So as far as the valuations go, you mentioned the last 15 years. We're recording this in March of 2023. There's been a little bit of turmoil in the marketplace in the last year with interest rates, and not to mention COVID and et cetera, with the supply chain stuff. What are you seeing as the most affected positively and negatively asset class for valuations?
So if you look at, you mentioned COVID, and then now, with interest rates, if you think back to COVID over the past 3 years, think not only multifamily, but then also industrial, and more specifically industrial, has been very positively impacted as we went more to online shopping as opposed to, in store shopping. Is industrial has had just a phenomenal, and then also think of the amount of money that has been put into the system, think fiscal stimulus, think lower interest rates, quote unquote free money, much more spending that has occurred. And so warehouse has by far been, industrial warehouse has by far been the biggest, beneficiary in terms of sectors over the past 3 years from COVID. Looking to today, now as part of the inflation, and now the Fed now fighting inflation with the increasing interest rates and backing off on that liquidity, really all asset classes have been impacted. All sectors in commercial real estate have been impacted. But from a fundamental perspective, most of the impact has gone to office. And think of the work from home phenomenon. And yes, there's been more of a back to office focus in the US that's been less successful. I think everybody will argue as to eventually where, how much of that work from home will stay and how much back to the office there will be. But I think everyone will agree is it's not going to be the same as what it was, pre-COVID. And so from a fundamental perspective, if you need less office than you needed before the start of COVID, that's going to have an impact. And especially now, as you have more stress in the market, more increasing interest rates, people are more focused on expenses. Companies are more focused on expenses. They'll really look more closely at the need for the office space that they have, and really look at their return to office policies on a go-forward basis. From a fundamental perspective, both from COVID, but also now just the stress in the industry and in the economy, is office has been most impacted.
Yeah, no doubt. I'm curious, the clients that you work with, the commercial industry, the commercial real estate industry is kind of far and wide. Is it primarily the investor side, or is it lender side, or is it all of the participants in the real estate market?
A little bit of all, but from the valuation perspective, valuation, especially the valuation, you mentioned the valuation management focus that we have. That's more on the investment manager side. So on behalf of the institutional investors will generally invest in a open-ended fund or in a closed-end fund. They'll commingle that money into a fund where the manager of that fund, the investment manager, will go out and invest and buy and sell and operate the real estate. So we'll work with those investment managers on the fund. We'll work on helping them with that mark to market on a quarterly basis, sometimes monthly, sometimes even daily. There's new products out there now where even on a daily basis, they'll need a mark to the underlying real estate. And so generally we do work with investors, we do work with lenders, but primarily it's the investment managers of that commercial real estate.
Got it. And with that mark to market requirement for the funds, have you seen a lot of willingness or letting go of some of the assets that aren't performing, or is it more a matter of just recognizing that the asset values have lessened in office type assets?
Yeah, and really just because of debt is a very important part of commercial real estate. And so as that cost of the debt, as interest rates have increased, that's going to impact the overall value of the commercial real estate, of the assets. Generally, the institutional investors use less leverage, so they're less directly impacted by it, but debt will impact just real estate asset prices overall. And so that has an impact whether you're buying for cash or buying for, or buying with leverage. So that has an impact. As far as recognizing, that is the big discussion right now in terms of, adjustments, to those marks. There's been a lot of, let's call it uncertainty, given that there's no transactions because of the uncertainty. How far is the Fed going to hike? Where's inflation going to be in, 3 months, 6 months, a year? Where's the fundamentals for office, not just now, but a year, 3 years, from now? A lot of questions right now, just in the macroeconomic part of the market, but then also the commercial real estate market as well, is there's a lot of questions is what is value, where is value at this point? And you have anytime there's uncertainty and there's a freeze up, there's no transactions occurring, you have what we call the bid-ask spread. What someone's willing to sell at, their asking price, is different what someone is willing to buy it at, the bid price. And so that spread means market value is not the asking price, it's not the bid price, but it's somewhere in between. And so that is especially when you get to office, that is a widespread. Everyone has the exact answer. They know exactly where the price is. It's just no one agrees as to where that is. If you're an owner, you're at the upper end of that range. If you're a buyer wanting to buy, you're at the lower end of that range. And so from a valuer perspective, is their challenge, and it's always a challenge in markets when there's no transactions. It's like logging into your stock account and you want to sell a stock and there's no buyers. Well, what's the value of that? You really don't know, or vice versa. If you want to buy and there's no sellers, it's figuring out where that is, and it's really using anecdotal information. It's a lot of communication, talking with brokers and investors and lenders and trying to get a feel and understanding all of that data and bringing that together and formulating opinion of value. So a lot of discussions, a lot of different opinions right now. Probably the best way someone, I heard one client, explain this is where, you may not know where the value is, but you know where the value is not. And it's not where it was yesterday. It's not where, where the bid is, where the ask is. It's somewhere in between. And so you triangulate using all that data. And probably right now, just talk about specifically with office data, is as you see some of the borrowers start, handing the properties back to the lender, is you now start saying, well, now it helps establish where that value is. Doesn't necessarily mean at that price, at where they, because sometimes it's just used for negotiating with the lender. But that's what you might consider more of a distress transaction, distress sale. That doesn't mean it's market value until you start seeing a lot more of that stress, which then becomes the market. And those are things that the appraiser needs to consider when they're determining what that value is.
Yeah, no, just kind of the scenario you were talking about there, where some of the investors are giving, properties back to the bank. That's kind of that I don't say a slippery slope, but it at least in the asset class of office, it seems like there could be a domino effect. But I'm assuming, are there not some on the bid side of the thing, of the bid ask, where there's some opportunist investors waiting for something like that to happen to acquire properties like that?
Yeah, absolutely. Is if there's a positive thing in the market right now, is that there is a lot of capital out there that still wants to invest in commercial real estate. There are people on the sideline looking. The same thing happened after the GFC. Same thing happened, back in the .com. Is you had a lot of investors looking to take advantage of any drop in price to get in for the longer term, because commercial real estate is more of a long-term investment. And so there is capital there waiting, but given the uncertainty, given the risk that they're ascribing to the unknowns going forward, whether it's on fundamentals, whether it's on debt, whether it's on pricing, whether it's on the economy, is they're waiting for a point. You could say the same thing with the stock market, waiting for a point where it reaches a certain level before they'll actually take the opportunity to invest at that point. And so this positive, there's capital there. The negative, from a perspective of looking at just value perspective, is it's not where the ask is now. It's definitely something lower that. And another way we look at it is, if you look at times where there's no transactions and there's a bid-ask spread, early in that cycle or in that time period, early is the market value is probably closer to the ask than it is to the bid. But every day that goes by, that things don't change and there's still that bid-ask spread, the value, that market value is likely, declining. You're going closer and closer to where the bid is. So where we are right now, we're probably, 9 months into, where things started, the Fed started raising, in the second quarter of last year. We're seeing where it's, we're starting to see those, declines, accelerate, or seeing more and more of those adjustments to market value.
Is there any data that you guys focus in on with respects to how close one is to their rate term expiring, or how old their debt is? Does that tend to be an action point where you see more, I don't say desperate, but more activity occurs based on, you're nearing a point where you've got maybe an empty building and you've got financing that's expiring, you're going to have to refinance, and you've got, the situation becomes more dire. Does that create any more of a need to act, or is it not?
Yeah, no, that's what we would call a compelling event, is or a critical event where when, and you mentioned, it's not just office, it's really, if you think about increasing interest rates, not only is that debt, so you may have a lower interest rate on that debt, and when it comes up for refinancing, is now it's at a higher level. So not only will you be paying more for the debt service on that new loan, but then also the value of that property, like that underlying collateral, that asset is likely declined. The fundamentals or the NOI of that property to service that debt has likely declined. And then on the flip side is there's more uncertainty, and you're not seeing the especially in office, we hear all the time it's unlendable. No lender wants to lend on office, just given the uncertainty of the values of that sector, specifically. So you have all those factors that come together. So yeah, we do track information on properties across the U.S. that where loans are coming due. That is a big focus this year, with the amount of commercial real estate loans that are maturing this year. And to your earlier, suggestion is what happens, as if more of those properties are handed back to the lenders, or even just negotiate with lenders. What happens when that accelerates, and if fundamentals don't improve, if the economy doesn't improve, if interest rates continue to go up further and values continue to decline further? All of that, is some of that risk and uncertainty that investors are looking at now, and therefore, from a buyer's perspective, demanding, or they're providing a lower bid before they actually, invest in the market.
So if we just exited a low interest rate environment, and most of the properties in the marketplace have lower debt on them, do you expect a kind of a wave as this, as the older terms start to expire, that this will then increase, and then that will kind of like create that the valuation? I mean, will that kind of like set the floor for the market, and at that point then the deals will start to happen because the price has been set? Is that kind of the 1, 2, 3 of it, or is it?
Yeah, I mean, if you do see, if it accelerates and you see if the distress, whether it's handing the keys back to the lender, or the lender then, they have real estate owned, an REO, and then they, they're not, in it for ownership. And so they're looking to get off the books. And so they then turn around and sell it, in those distress scenarios. If that becomes more the standard, if that becomes more reflects what's happening in the market because it's happening that frequent, then that's indicative of where market values, should be, at that point. And one thing I'll say with, and specifically when you're looking at office, and you could correlate this to retail, especially regional malls 10, 15 years ago, is it really gets down to not just, this sector, not just the market, not the sector within that market, but really down to the individual property, down to the individual assets. We used to say 10 years ago is with the regional malls, you had the haves and the have-nots. You had those that, if you think of, of a city or a metropolitan area, and if you had 5 malls, it's likely to go down to 2 malls or 3 malls. And so the haves, those that will actually, and might benefit from closing of a couple of malls, and then those that just likely won't make it, in a 5 malls in a 3 mall town. We're starting to see the same thing with office, is as there's less need for office space, think work from home, think, if the economy slows or goes into a recession, there's less need for that office. Is which buildings will do very well, the top of the market, which ones will do okay, and which ones it'll be at the expense of the other, the third component there. And so you really have to look at those individual properties. What are the amenities? What are, ESG is a big focus now. Tenants won't look at certain buildings unless they're, certain LEED, certification, and so it becomes much more focused, again, not just on the market, but now that particular, that particular asset, especially when it comes to office. And so it isn't just a, hey, everything's down, X%. It's, what is this building relative to other buildings in that market? Makes it
Yeah.
much easier. Yeah.
Yeah. So the average, what's an average term as far as debt financing for office? Is it 7 to 10 years as far as a rate lock,
Yeah,
or
more like 5. More like
5?
5 years. Yep.
Okay. So theoretically, if we're in year one of higher interest rates, within 5 years, this will reset. Is that okay?
Well, you could say you're seeing the reset now, because
Right?
as those low interest loans, that low interest debt over the past 5 years, have been, and the term can be longer than it as well, but let's call it 5 to 7 years, is past 5 to 7 years, as that's now coming due, that's when the reset occurs, is when you adjust to that new level, because can that property support that new level of debt service? And at the same time, I mentioned all the amenities needed in office, that requires investment, into the building. So is there equity? Is there capital there from the owner? Is there willingness, from the owner to invest that extra capital into the building in order to support long-term the debt service on that new loan? So that's really starting to happen right now. Then you've started seeing, some things, from the lending perspective on office, is some properties going back or being negotiated with the lender, is happening over the past, let's call it the past 3 months. That's what, we're watching very closely over the next, 6 to 12 months, next 2 years, as to what happens in terms of as those loans come due. Then for the next 5 years, as those are renegotiated or extended or have new loans at that higher level, that actually helps the market longer term, because now if it has new lending, or it has a new owner, or if it was handed back and it was recapitalized with a lower level of loan against the property, then now that helps that asset. It's repriced. That helps the asset and the market on a go forward basis as well.
Right. Definitely the go forward, once you get through that stall and the bid ask and all the lending there. So if you were going to advise the listeners on what to do or how to prepare for the next, or as we go through this transition, what would your advice be for how to prepare and what to do to get through this?
Yeah, I would. I'd say, I mentioned, earlier, is just, communication is very important. So it's, being, with the lender, with the broker, with participants in the marketplace, is as everyone's trying to figure, this out, is very important. And the second thing is, and it's gotten better, over the past, 20, 30 years, but is with the data, is having the data, and you mentioned at the earlier, just data insights, when in Altus as a whole focuses on intelligence as a service. And so providing not only that, the advice, the as a trusted advisor, not only having the software, the technology behind it, but having that data and bringing that data together to make those informed decisions, whether it's on an acquisition, whether it's on a disposition, or whether it's on an ongoing ownership, which, back to, especially, you think offices, which ones are the haves, which ones are the have-nots, based on the just voluminous amount of data that's out there in the market, bringing that together to make an informed decision on what your strategy is, acquisition, disposition, or, ownership, or improving and reinvesting in the property. Is data is just so critical. Right now, anytime, it's funny, and just some of the data that and advisory services that we provide to our clients over the past 10 years, it wasn't being used that much, because you just saw just a very consistent 1%, every quarter. Was just, you saw the tick up right up to COVID. And there wasn't that need for that amount of data and the analytics behind that data. Now, as you see volatility, but probably more importantly, the uncertainty in the market, now it's even more critical to have that, information right now. So those are probably the two things. It's communication, talking with people in the industry, but then also having the data, to make informed decisions. Those are probably the two biggest things.
Got it. Hey, Rick, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, And as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. And if that's not an option, then we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, investors, tenants, the market, interest rates, political, however you would like to identify what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Rick Kalvoda, what is the biggest risk?
Yeah, I think so operating expenses, of which, insurance is a big component, of the risk. I think right now of ownership of commercial real estate. I think right now, and this kind of goes back to the uncertainty and what's going to happen with inflation, what's going to happen with interest rate, what's the Fed going to do, is just, it's the uncertainty. And as the Fed continues with that increase, is the biggest risk right now is there a global financial crisis? You're starting to see the stress in some of the banks. You're starting to see, as I mentioned, with some of the lending or the borrowers, handing keys back to the lenders. You're starting to see some of that at the same time, slowing economic growth, and also increase inflation. All that stress to the economy, that if we go into a recession, if we continue to have higher interest rates and that's going to have an impact, not just on commercial real estate, but across all asset classes, but then specifically with commercial real estate, and especially with, the amount of lending done by the regional banks, which, are over the past couple of weeks, I've seen this stress, that's probably the biggest, concern out there, and biggest risk for our investor and for our clients is just what happens, the overall macroeconomic picture. And there's just so many different, things impacting it. On top of that, back to your comment just on insurance, is just with the you just think of the climate risk and everything that's happened this year, and how that impacts commercial real estate, whether it's rising ocean levels, et cetera, is all of that has so our clients, the owners and operators of that commercial real estate, not only have to think about that, but then the macroeconomic side of it as well. So a lot of risk now, hence the uncertainty, but we're all here to help the industry out, in times of risk like that. Yeah.
Yeah, no, plenty of risk to go around. That's for sure. Hey, Rick, where can the listeners go if they'd like to learn more or connect with you?
You can go to our website, altusgroup.com, and reach out, and we're happy to help, with any data, software, services needs they have in the commercial real estate business.
Awesome. Well, Rick Kalvoda, I cannot say thanks enough for taking the time to talk today. I've enjoyed it. I learned a lot, and I look forward to doing it again soon.
Absolutely. Anytime. Thanks, Darren.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.